Hello, my name is Jackson Tyder, and today I want to talk to you guys about credit scores. So, I'm sure a lot of you are familiar with what a credit score is, at least from things like student loans and stuff like that. So, I just want to kind of delve into the meat and potatoes of it because I'm a finance major at Salisbury, so I think it's very important that we actually look at, and it's a subject I'm very passionate about, that we actually look at credit scores because I don't think a lot of people actually understand fully what they are. So, I want to talk about the history of a credit score, what a credit score actually does, and how it's calculated. So, according to FICO, the idea of a credit score dates back to the 1840s with the Mercantile Agency, and they compiled a list of factors, including unfortunately prejudiced ones such as race and ethnicity, to try and assess risk. And because it was not standardized and it was including so many prejudiced factors, it was not a level playing field. And it was not very dependable for lenders as they were judging people for stuff they had no control over and were eliminating people that were low risk just due to prejudicial factors. So this evolved in the 50s and 60s, where, according to American Express, the idea of a standardized credit system and score kind of originated from. And this continued to evolve into 1989, where the FICO score, Fair, Isaac & Co., which was founded in the 50s and 60s and really pushed the standardized credit system and score, finally made it standardized nationwide. So today, it now ranges from, according to the FTC, 300 to 850, as a credit score, with 850 being the best and 300 being the worst. But before, it could range from literally any amount of numbers in any range, with even at 0 being the best and 1,000 being the worst. So it's just endless, and it was very hard to read and decipher, and it led to a lot of mistakes and a lot of people being denied credit they shouldn't have. So what is credit actually used for? So one of the main things credit is used for is, or credit score is used for, is getting a mortgage. So it determines how much of a loan a bank will actually give you, whether it's like 100,000 or 200,000, what level of interest you'll receive, and any like covenants in it that you like. Say you have a weak credit score, the bank might not let you get a fixed interest loan where your payment stays the same throughout the entirety life of your mortgage. But you might have to get an adjustable rate mortgage where your payments fluctuate as the interest rates fluctuate throughout the economy. Another thing that credit scores are heavily dependent on are credit cards. So it's in the name, credit card, credit score, it's very similar. So credit card companies use your credit score to determine whether you're approved or denied for their services, what the maximum credit line they'll give you, and like say they'll give you 1,000 with this credit score, but 5,000 with this credit score, and what interest rate you'll give. So what effective annual rate will you have to pay on any credit that you leave and use. So another thing that credit score affects is, even if you're not planning on buying a home, it affects you renting a home, according to FICO, because landlords, they look at your credit, and if you have a high credit score, they want you better because you're a more stable cash flow. There's no uncertainty in you. So they'll offer you things such as reduced security deposits. So now that we know the history of a credit score and what a credit score can be used for, I really want to dig in the important part of how a credit score is calculated. So there's four very main factors. Now, according to Equifax, there are three main credit bureaus, and each weight them differently, but there are four main factors according to Equifax. So that is you making every payment on time, so your payment history, because even one missed payment can one missed or late payment can harm your credit score very much. It can very much just tank it. Because credit companies and people who are lending money, they don't want you to be a liability. They don't want a risk. They don't want uncertainty. They're relying on the stability of your cash flows to pay their operations. The second factor is your credit age. So they will put far more weight into someone who's had a credit history of 20 years ago, or for 20 years long, who's made every single payment, than someone who just got a credit card last month and has made one payment. Because even though they've all made all their payments, one shows a far longer history and pattern of making their payments. The third factor is your credit utilization. So while you might have $1,000 available, you can only really use 300 of that without your credit score starting to harm, because using too much of it shows that you are kind of going out of your means and going beyond your means to try and afford things. And the fourth most important factor is your hard credit checks. So when you go to apply for something using credit, they'll typically run a hard credit check where they will check your credit and make sure it's accurate. And that lowers your credit if you do too many at one time, because it shows you're kind of overextending yourself and your credit score might not be fully updated and reflected. So it's a lot of financial jargon that's been discussed right now. So the important things to take away from this are that a credit score affects more than just what you think. It's not just your what interest rate you pay on a credit card, but it's your housing, it's your future, it's your everyday life. And with that, thank you.